Standard retirement advice usually follows a specific blueprint, the 60-40 portfolio. 60% goes into stocks for growth, and 40% goes into bonds for protection. The stocks act as the engine, while the bonds serve as the seatbelt. This strategy relies on a historical reflex. When stocks crash, fearful investors move their money into the safety of government debt. This rush toward quality drives bond prices up, which offsets the losses in the rest of the portfolio. This safety net is part of the $145 trillion bond market. It is an invisible machine that quietly prices your mortgage, your car loan, and the job security of your employer. Because of the scale of this machine, generations of investors believed that nearly half of their life savings was shielded from catastrophic market crashes. In 2022, that protection disappeared. Both stocks and bonds plummeted at the same time because the cause of the sell-off, rising interest rates, was toxic to both asset classes. This chart captures the break in the pattern. In 2022, the 60-40 portfolio lost 16% of its value. The longest-dated conservative bond funds fared even worse, losing 39.2% in a single year. A Santa Clara University analysis found that this was the worst year for long-duration U.S. bonds since 1754. To put that in perspective, the United States did not exist yet, but the safe side of American retirement portfolios was having its worst year in nearly 3 centuries. Millions of retirees discovered that their infallible financial safety net was actually accelerating the destruction of their wealth. At its core, a bond is just a loan contract. It is a promise to pay regular interest and ensure the return of your principal on a specific date. This contract follows one mathematical rule. When new interest rates go up, the price of old bonds goes down. If you hold a bond paying 3% and the government begins issuing new ones at 5%, your bond becomes less valuable to any potential buyer. This is exactly what happened in 2022. The Federal Reserve hiked interest rates from near zero to over 4% in just 9 months. These aggressive hikes acted as a systemic poison, dragging down the street value of existing bonds across the entire financial system. For an investor holding an individual bond to maturity, these price drops are mostly a distraction. As long as the borrower doesn't default, you collect every payment and get your full principal back at the end. Most people, however, do not own individual bonds. They own bond funds, which are managed baskets of debt that never actually reach a maturity date. These funds must reprice their entire basket of assets every single day. As the Fed raised rates in 2022, the losses on those statements became real and permanent. Bundling safe individual loans into a daily traded fund creates a highly volatile, unprotected asset class. Every bond fund's fact sheet includes a metric called duration. It measures how sensitive that specific fund is to changes in interest rates. Duration shows a fund's loss for every 1-point rate hike. On a $500,000 portfolio, a duration of 6, common for broad funds, loses $30,000. In a long-dated treasury fund with a duration of 17, that exact same hike causes an $85,000 loss. Duration is the mathematical difference between a minor financial bruise and a broken leg. The catastrophic events of 2022 shattered the myth that an asset labeled as a bond automatically guarantees safety. The longer the maturity date on a bond, the more it mimics the volatility of a corporate stock. True risk in the modern financial system is a function of time. The longer you are forced to hold an asset, the more exposure you have to shifts in the macroeconomy. To understand your own exposure, you have to look past the conservative labels on your retirement accounts and actively find the duration number hidden on your fund's official fact sheet. Any duration above 7 indicates that a portfolio will swing violently when interest rates move. A bond fund with a duration above 15 functions as a highly speculative asset, carrying risks that many savers never intended to take. The bond market governs every single dollar you touch. Ignoring these mechanics allows an invisible machine to hand you a devastating bill without ever sending an invoice.